Hello everyone, welcome to Tax-o-phile. This is Vaibhav. Today's our topic is tax planning versus tax avoidance versus tax evasion. What are the basic differences between these three terms? Everyone wants to give some lower tax. No one wants to maximize their tax cost. So what are the methods? Why a person resort to any of these methods? Why what is the difference between tax planning, tax avoidance and tax evasion? Sometimes, to minimize the cost of the tax, some people resort to the application of tax avoidance or tax evasion. So, what are the consequences if they resort to the tax avoidance or the tax evasion purposes? So, we'll discuss everything in this session. If you are new to our channel, please subscribe for getting the latest updates from our site. Let's start to the session. What are the topics we are going to discuss in this session? First is the introduction. What introduction it is? It is about why these terms are derived. What is tax planning? What is tax avoidance? And what is tax evasion? Then we'll discuss in detail what is tax planning. Why every person needs tax planning? Isn't it like every person wants tax planning, or some person want or some may not? So what is the criteria? We'll definitely see. Methods of tax planning. What are the methods of tax planning? How is the tool of tax planning exercise? What is tax avoidance, tax evasion, and finally the difference between the tax avoidance and the tax evasion? These are the very uncommon. These are the very commonly uninterpreted or wrongly interpreted words which are going to be discussed here. What are the basic difference between these two terms, tax avoidance versus tax evasion? So let's start with the first topic. What is the introduction? As I already said, taxpayers don't want to maximize their tax cost. They want to minimize their tax cost. So for that, they resort to any of these methods, either tax planning, tax avoidance, or tax evasion. So the main goal of every taxpayer is to minimize his tax liability. To achieve these objectives, or may resort to the following three methods, whether it is tax planning, tax avoidance, or tax evasion. It is very well said that taxpayer is not expected to arrange his affairs in such a manner to pay the maximum tax. Every taxpayer wants to pay the minimum tax. No one wants to pay the tax maximum. So it is not expected from anyone, any taxpayer, to arrange his affairs, arrange his transaction during the previous year in such a manner to pay the maximum tax, or his liability to pay the tax becomes maximum. So the assessee shall arrange the affairs in a manner to reduce tax. But the question, what method of form? But this question still arises. What option, what method is still beneficial for the assessee? Whether it is tax planning, tax avoidance, tax evasion, what are the differences between them? If someone is resorted to tax avoidance or tax evasion, so what are the consequences they have to fear? So we'll discuss everything. First is, what is tax planning? So the basic idea regarding the tax planning is, a person, a taxpayer, a assessee is within the frame of the law. He is within the frame of the law. He is not obligating, or he is not violating any part of the law, any intention of the law, or any letter of the law. He is following the law in spirit or in letter, in both terms. So if someone is planning, if someone is taking the benefit which is already given in the law, the benefit, the intention of the law, the spirit of the law, and the letter of the law, all are to give the intent, to give the benefit to the assessee. If you are using those benefits, if you are using those sections, then you are planning your taxes. So it is, first thing is, it is very legal form. It is a very legal form. You are within the four corners of the law. So the tax planning is the skill of utilizing the numerous legal ways, legal laws, to lower a person's tax bill. There are, everything is legal when there is called a tax planning. So you are within the four corners of the law. So the government frequently offers a variety of deductions and exclusions that a person can use to lower his tax liability. Tax planning is making sure you take advantage of all the acts allowed, exemptions, deductions, and rebates. Sometimes we have to plan our taxes that we use the maximum tax benefit sections, like we use the every deduction which we can use the exemptions which are given under section 10 of the income tax act. We can use the rebates and the relief under income tax act. we can use probably all the sections which are applicable to us. If this is not the tax planning, which if we have something, if we have the utilization of some sections, we can utilize those sections, but we are not. These are not called tax plannings. Tax planning is called when a person has a set of bunch of rules and regulations which he can use legally. I'm repeating the word, which he can use legally. If he is using those benefits or those exemptions, those rebates legally and in all, then it's a tax planning to arrange its affairs where the person maximizes his tax planning, maximizes the rebates, exemptions, and reliefs so that the tax revenue will be lower. So the few examples is what are the few examples? Exemptions under Section 10, rebates and relief either Section 87A, 88, 89 of the Income Tax Act, or deductions under Section 80C to 80. These are the expenditure based deductions where you have to expend something and you'll get the deduction. 80C like life insurance policy, 80T for health insurance policy and all. So to plan your tax, you have to be within the four corners of the law. You have to follow the law in spirit and in letters. You should have to use both. You can't use in the letter only or disobeying the spirit, or you are obeying the spirit but disobeying the letters. So you have to be in both. So some examples of the provisions जिसमें आप benefits ले सकते हैं. The investment provided in the section 1015 of the Income Tax Act. So interest on such securities is fully exempt. Exemptions under Section 10, 10A, 10A, 10B, 10BA. Residential status. You can use your residential status to plan your taxes. Like the residential status in India under the Income Tax Act is on the basis of 182 days or more. So if you are living in India under the 182 days or so, or to per se like 180 days or 80 days, so you can plan your taxes. You become the non-resident in India, and on the non-resident, all income, the global income is not chargeable. So some particular incomes are only chargeable. So you can plan your taxes as per the basis of your residential status. Choice of accounting system. Accounting system choice, like you can follow the mercantile system, you can follow the cash system, whichever is suitable to your business and whichever is suitable for your planning the taxes. The way you can maximize or minimize, you can minimize the tax returns, you can maximize the benefits you can get. So you have to choose the accounting system so far. So for that, remember one thing: whichever accounting system is you are using it thoroughly, using it throughout. Because if you are changing accounting system year on year, then you may be covered under Section 144, and the AO will get the chance to do the best judgment assessment under Section 144. So you have to keep in mind whatever the accounting system you are using, whether it is mercantile system or the cash system, you have to follow the throughout. Then choice of organization. Someone says like for me the HUF is beneficial. For me the firm is beneficial. For me the partnership firm is beneficial. For me the company is beneficial based on the different tax rates. Some has the different tax rates, some other tax rates. So to organize their structure, to organize their organization, to manage their organization, or to opt the organization system which helps you to minimize your tax liability, can also be called as a tax planning tool. You can plan your taxes in a way that you are within the four corners of the law, but you are not violating the law and getting the maximum benefits out of the law with minimum tax liability, is known as the tax planning concept. For availing the benefits, one should resort to bona fide means by complying the provisions of law in letter and the spirit. What is written is to be followed, and what is intended is also to be followed. You cannot say what is written, I am following it, but I am not following the spirit of the law. So what will be the consequences? What is called? We'll see that afterwards in this session only. But you have to follow the law in the spirit and in the letter. Then only you will be called as a tax planning. You are doing tax planning. If you are following in letters, if you are following in spirit, then only you can be called as a tax planner. You are doing a tax planning. So now when a person, what is the tax planning? I can give you a simple example. Like if we have to bought if we have to buy a machinery, it is our decision whether to buy it or to rent it or to lease it. If I can buy, so I can get the benefit of depreciation. If I have to lease it, I can get the lease rentals, the deduction for lease rentals. So whichever is beneficial to us, whether the depreciation makes my profit lower or to so that my tax will be lower. So I'll use the depreciation method. I'll purchase it. I'll purchase the machinery. But if the rentals are higher, so I can get the rentals. I can get it on the lease. So pay the rentals. I can get the deductions under the income tax act. So my tax profits will be lower. So my tax will be lower. So to maximize your return and minimize your tax liability based on these circumstances which are allowed in the law, in the spirit and in the letter as well, so you can plan your taxes. So this is the example. Now, why every person needs tax planning? Why we need tax planning? As I already mentioned, everyone wants to pay the minimum taxes and maximize their returns. No one wants to give the taxes to the government. They want to utilize on their own selves or to the family. So everyone needs the tax planning. No one wants to give the maximum profits or maximum share of their profit to the government. So tax planning is resorted to the maximum cash inflow and minimum cash outflows. Your tax is your cash outflow. So everyone wants to minimize their cash outflow. Every prudent person to maximize the return shall increase the profit, and to increase the profit, they shall definitely resort to tax planning methods. Methods of tax planning. We till now said many times what are the methods of tax planning. Now, what are the actual methods of tax planning? There are four methods of tax planning. First is short-term tax planning. Second is long-term tax planning. Third is permissive tax planning, and fourth is purposive tax planning. So, what are these tax planning methods we are going to discuss in this session afterwards? First is short-term tax planning. What are the short-term tax planning? Short-term tax planning are those planning which are executed at the end of the financial year or the end of the previous year. Like your period is between the 1st April to 31st March. When your financial year is ending, you are following some techniques or some tax measures which can lower your taxes. So short-term is the short-term which we are using for that financial year or for the short-term period of time, because to get the exemption under the tax laws or to minimize their tax costs. So suppose at the end of the previous year an assessee finds his taxes has been too high in comparison with the last year and he intends to reduce it. Now, now he may do that to a greater extent. He making proper arrangement to get maximum tax rebate under section 88. 88 is rebate or relief you can get on the life insurance premium. So you can get those 88 section reliefs. So these are planned at the end of the financial year when you are about to complete your tax year. You are about to complete your financial year or the previous year. You resort to some or the other method which can which you can apply to minimize your tax liability and maximize your returns. So for the those methods, those matters which you are applying at the end of the financial year or the end of the previous year, these are known as the short term tax planning. And what are the long term tax planning? Like short term is after the financial year or at the end of the financial year, but long term is at the start, at the beginning, and at the end, which is followed throughout the financial year. Which is followed throughout the financial year. This is the starting to the end from 1st April to 31st March. This is a period of 12 months. So if you are planning something, if you are arranging your systems, if you are arranging your methods, or if you are arranging your transaction in such a manner that you'll follow it throughout the financial year, then this will be called as a long-term tax planning. What are the long-term tax planning example? Like if you have a son or a daughter and they are earning something from some shows or something else, so under section 64 they will be clubbed, their income will be clubbed under the higher earning parental income. Okay, if there is a son or a daughter earning something, So under the Income Tax Act 1964, the income of the child will be included under the higher parent earning income. But suppose if we invest, if that son invest his money in some shares or securities or mutual funds. So the return which the son gets, which the child gets to you, will be taxed under the child's income, and child will also get the slab of 2.5 lakh. Understanding it? So you are changing the slab, you are changing the taxable person as well, but under the section 64, you are not you are managing your affairs in that manner that that the section 64 is not applicable on you. So it is followed throughout the year. Whenever the income comes, the son invested, and what are the yields they get, there will be taxes under the heads of the son or the child or the daughter or child. So these are the tax planning which we do throughout the year, like from this very scratch to the end of the financial year. We are from scratching from the beginning of the financial year, we are getting some income. During the financial year, the son invests that income, or at the end of the financial year, the son yields some get some yields from that income or through that shares or mutual funds. So the income will be counted under the hands of the son, and son will also get the benefit of 2.5 like the basic exemption limit or the rebate under section 87A as well. So the 5 lakh income you can easily transfer to your child's hand if they are earning so. These are called as the long term plannings. Now what are the permissible tax planning? Permissible tax planning are those planning which are permitted by the tax. Like the name suggests, permissive tax planning. It is like what are the methods, what are the ways that tax already suggested you can do so to maximize your return and minimize your tax cost. So these are called as the permissive tax planning. Like section 10(1), you can earn that much of agriculture income that will be exempt. So these are called the tax exemption, tax planning methods which are already given in the law, which are permitted by the law to do so. Like Tax 10(1), planning to take advantages of different incentives and deductions like ATC, ATD, ATDD, if you are having a disabled person with you. So ATU, there are various methods you can do so. You can have a preventive health checkup for which the 5,000 paid in cash is also allowed. So these are the allowed expenses which you can incur to plan your taxes, to pay the lesser taxes as you were paying earlier. So these are called the permissive tax planning. What are the purposive tax planning? Purposive tax planning are those tax planning which are done for a specific purpose, which are done for a specific purpose, like to check the to ensure the availability of maximum benefits to the assessee through the correct selection of investment, making suitable programs for the replacement of assets, varying the residential status, and diversifying the business activities and income tax. If you are doing something for purpose, if something has a purpose in itself, if something is purposeful, then the tax planning for that purpose only, for that specific purpose only, you will be supposed to doing the purposive tax planning. If something, tax planning and whole is a very broad concept. If you are doing just to plan your taxes, like for per se to say, if I have to say like machinery, just to purchase that machinery, whether I have to purchase it or I have to buy it, I have to rent it or I have to lease it, if this decision is to be taken, I could say it is a purposive tax planning for a specific purpose, for a specific machinery, for a specific part of my business. I am doing some tax planning is known as the purposive tax planning. So there are four methods of tax planning: short-term tax planning, which is done at the end of the financial year; long-term tax planning, which is done throughout the tax period; the permissive, which are permitted by the tax law; and the purposive, which is done for a specific purpose. Now, how is tool of tax planning exercise? Some first you have to understand, you have to plan your taxes before the accrual of it. Once the income is arised, you'll get the income from someone, it is accounted. Now you cannot change. If you are changing it, then we'll see in the further slides what will it be called. But If you plan your taxes, plan before the accrual of your income, like where the income should come from, like whether it will be called as a son's income or my income. You have to plan it in that way only. Like I have to invest the money in the shares of mutual fund, so the yield which the child get will be included in his taxable income, his or her taxable income. So first things you have to keep in mind, that the tax planning is to be done on the accrual or before the accrual of your tax income. Then choice of an organization, whether you want to choose the company, or whether you will take the 25% well slab, or you want to take the 30% slab, or you'll go in the alternate regimes, whether the med will be applicable to you or not. So whether I want to open a partnership firm or the LLP or a sole proprietorship. So you have to choose the structure of your organization in such manner that you can minimize your tax liability. The choice of an organization also helps to reduce your tax liability in the very higher point. So the third is location of your business. Like some business can be located in the normal areas, the industrial areas, and some can be situated under the SEZ zones, because special economic zones. So for the special economic zones for the SEZ businesses, the government give the exemptions under Section 10AA, and then you'll get the tax holidays as well for the 10 year, and for the extended to 5 years as well. So you can plan it as well. What are the locations of your business? Whether you want to locate your business in the like gift city, you want to locate it in the SEZ centers, whether it will be IFSC businesses or not. So everything matters. So for that, you have to do it the pre-planning. Whether you want to change your business structure, whether you want to open your business structure in the tax holiday areas, or you have to before the accrual of your income, you have to plan your taxes. Then the residential status, as I already said, if the resident you become resident in 182 days in India, but if you reside here only 181 days, and 182nd day you are not in India, so you not become the resident. Either you will become the resident and not ordinary resident, or a non-resident. So in these two cases, the not your global income will be taxable. The certain amount of income will only be taxable in India. So you can plan your taxes based on the residential status as well. Choice of buy or lease, as I already discussed, whether you want to buy a machinery or to take it on lease, it will also be your decision definitely. Then, what is tax avoidance? Till now, we have done what is the part of the tax planning. Now, we are coming on the tax avoidance. Tax avoidance is legal way. I am not saying it is not legal. It is legal, but the intention of law was not to give you that benefit. I am repeating my words. You are under the four corners of the law. While you are doing the concept, to understand the tax avoidance, you can say, I am within the four corners of the law, but the spirit of the law was not intended to give me that benefit. So you are within the four corners of the law, same like the tax planning. But in the tax planning, you have to follow the spirit as well. But in the tax avoidance, you are avoiding that spirit. You are getting the false claim. You are taking the you can say the benefit of the law, which is not followed in the spirit of the law. So here the spirit of the law matters. What is written is okay. You are following the law. You are following the words of the law. You are following the letters of the law, but you are not following what is actually intended. Why this text, why this provision has been made by the finance ministry, why the income tax department gives you that provision, what are the intention behind it. You are not following those intentions, you are disobeying the spirit of the law, is termed as a tax avoidance. So the tax avoidance primarily refers to using the tax laws loopholes. You are following the tax law loopholes. Something is written, but you are saying what is not written. What is not written, I'll do that. I'll be in the four corners of the law. The law is not restricted me to do so, but the spirit of the law is restricting you to do so. So you have to see the spirit here. to one's own advantage in order to pay the less in taxes. Tax avoidance, same, it is 100% legal method, same lines with tax planning. However, it is not recommended because the taxpayer has subverted the law's intended purpose, the spirit of the law, and used this on his own advantage. The tax planning and tax avoidance both are the legal ways, the legitimate techniques. You can follow the tax planning, but in the tax avoidance, if you follow, so there will be you are following, you are taking advantages of something which is called as the tax loopholes, which are not covered under the tax, but the spirit of your the spirit of the taxmakers, the lawmakers, were not to give you that benefit. So the difference between the tax avoidance or the tax planning is tax avoidance is when a taxpayer does something that government didn't anticipate them to do. So government don't want you to take those benefits. That is the tax avoidance, and you are taking that benefits. And tax planning is where the government wants to take you that you take those examples, those benefits, those exemptions, those reliefs, those rebates and deductions. The government, if explicitly saying that you can use these methods, and if you are using these methods within the spirit of the law, it is called as a tax planning. If the government is saying something and you are disobeying the spirit of the law, the intention of the lawmakers, then you are under the frame of the tax avoidance. And to add it on, the for the purpose of just tax avoidance, the provisions called as GAR, GAAR, General Anti-Avoidance Rules, General Anti-Avoidance Rule has been made applicable by the government of India for to just keep track on the tax avoidance measure, that someone is not taking the tax avoidance. If he has done something which is under the ambit of the tax avoidance, so how it will be treated. So just for the sake of the tax avoidance purposes, the government made applicable the general anti-avoidance rules. And then in the other one, taxpayer has complied with the letter of the law but not complied with the spirit of the law. Some transactions which can be held under the tax under the tax avoidance. First is where the tax laws is complied with by using collateral devices, which means use of method that is unfair for reduction of tax liability. If you are using something which is not a spirit of the law, but it is in your benefit, it is in your own benefit, you are doing it by the unfair means to reduce your tax liability, is covered under the tax avoidance. The fact of the case is presented in the false manner. If you have presented your tax case, if you have presented something in a false manner to surpass the spirit of the law, then it will be called as a fact of the tax avoidance. The spirit of the law is avoided. The if you have the malified intention, definitely if you have a malified intention, then you will be covered as the tax avoidance. If you are very clean, if you have your clean intentions, then definitely you will not surpass the spirit of the law. So if you have a malified intentions, then you are surpassing the laws in the spirit, and so you resort to last the tax avoidance. And something and someone who has a malified intention, who claims the false receipt or the false manner of their taxes, they can even also resort to the tax evasion. When it will be resort to tax evasion, we will say the coming slides. Like the method adopted for reducing the tax liability should be within the framework of the law. If it is not within the framework of law, it amounts to tax avoidance or not the tax planning. Okay, understood. I hope you are understanding these topics till now. Now, what is the we are having the last topic. After that, we'll see the difference between the tax avoidance and the tax evasion. So, what is the tax evasion? Tax evasion is we have seen the thumb rule, like you have to follow the law within the spirit of the law as well, and within the letters of the law. In the tax evasion, you are not obeying any of these. You are just disrespecting the law. You are just disobeying the law. You are just doing anything from your mind to lower your taxes, to minimize your taxes. You are not within any framework of the law. You are violating each spirit of the law to just minimize your tax in your own benefits. So if you are not following the law in the letter way, or if you are not following the way in the spirit, the law in the spirit, so you are under the tax evasion perspective. You are under the ambit of the tax evasion. And for the tax evasion, you can face very serious consequences. We'll see in the upcoming sessions what are these the consequences of the tax evasion. But tax evasion or tax avoidance both are not suggested by anyone. People can use those things to minimize those taxes by tax avoidance or tax evasion, but they have the consequences as well. The people have to face the consequences by either by the fine or by taking the higher penalties or maybe sometimes the jail. So the tax evasion is the illegal practice of failing to pay the pay taxes when required to do so by the law. By exaggerating their expenses or inflating their income, people who engage in the tax evasion attempts to decrease their tax liability in an illegal manner. In an illegal manner, it is not legal. The effect of increasing expenses while simultaneously deflating the income in the same, the profit is reduced, which lowers the tax burden. You are increasing your expenses while simultaneously you are deflating your income. Like you are showing the false expenses. You are showing like we are a company of 20 people, but in actually you are a company of only 2 people. And for those 18 people, you are paying the extra salary. So you are claiming the extra exemption, extra expenses. You are claiming the expenses higher side, and in the same side you are taking some your income. You are taking some income in cash, so you are not showing your income sides as well. You are not showing the correct income of yours. So either you are inflating your expenses or deflating your income. Both will resort to tax evasion if they are illegal. If they are in the legal ways within the spirit of the letter, so there will be tax planning. All illegal methods will lead to the reduction of the tax liability is known as the tax evasion. This is just a single liner summary of tax evasion. Her illegal method which leads to the reduction of the tax liability is known as the tax evasion. Tax evasion is resorted to by applying the following dishonest means, like claiming the excessive expenditure, like we said, see the example of the salary, willful violence of rules. If you are not, if the law rule says this, you have to do this by this method, but you are not following this or that method. You are following your own made method, the homemade method, the Atmanirbhar Bharat method. So it's not so. You have to follow the rule which is written in the law. The falsification of accounts. You are framing your accounts. You get your accounts audited in the false manner, which are not actually intended, which are intended to do so because to minimize the tax liability. So you are getting your accounts wrong. For some expenditure, you have to show expenditure of let's say you have to show two expenditures, but you are now showing the 20 expenditures. You are inflating your expenditure sides in the of the PNL, and you are reducing your income sides in the PNL. Then it will be called as a tax evasion method. Then concealing of your income. You are concealing your income. Well, you got your income, but you got in the cash. Now it is not accounted in either in bank or in your uh, accounts. So it will be like a concealing of income. You get these income, but it is not accounted for. The tax is not given on those incomes. So it will be resorted to the tax evasion method. For example, claim and depreciation where no asset exists. You are taking an you are taking a deduction of depreciation, but there is no asset in the business. You are claiming the false deduction or the depreciation. You are claiming the higher side of your expenditure to minimize the profits so that you can pay the minimum of the taxes. So last, what are the difference between the tax avoidance and the tax evasion? First, tax evasion or tax planning. Tax avoidance is complying within the provisions of the law, but it is not in the spirit of the law. Tax evasion is, it is the wholly illegal way. You are either not complying with the provisions of the law or even the spirit of the law. Tax avoidance. you are taking the advantages of the loopholes. The law is saying something, but law is not also saying this thing to not do so. Like law is saying you have to do this, but law in no way defines that you do not have to do this way. So if I am applying that method, which law does not uh, explicitly say to do not to do so, so it will be the advantage of the loopholes which we are taking the tax avoidance, and tax evasion we are doing the unfair means. In the tax avoidance, our intention is not malified, but in the tax evasion, our intention is malified. Tax avoidance is done when the before the tax liability arises. Tax tax avoidance is done before the tax liability arises during the previous year or during the tax year. You have to do the tax avoidance measures. But tax evasion is done after the period, after the tax period or after the previous year. So these are the basic differences between the tax avoidance and the tax evasion. I hope you liked the session. Thank you so much for joining. We have so many viewers today. So if you have any problem, if you have any doubts in related concepts, you can reach us on these given the contact details, and the details will also be highlighted in the afterwards of the session. So if you like the session, please subscribe our channel, share with your friends, like our session, and to get the latest update, please hit the bell icon as well. Thank you so much for joining us. अगर आपको हमारी वीडियो अच्छी लगी हो और आपने अभी तक चैनल सब्सक्राइब नहीं किया हो तो दिस इज आवर चैनल, आप प्लीज इसको सब्सक्राइब कर सकते हैं, आप बेल आइकन दबा सकते हैं जिससे कि आपको सारी लेटेस्ट अपडेट सबसे पहले आप तक पहुंचे। थैंक यू।